Welcome to our Intermediate Trading Concepts series. Today, we're diving into the basics of options, a versatile but complex financial instrument. Options provide unique opportunities for traders and investors, but they require a good understanding of their mechanics and risks. Options are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a certain date. They can be used for hedging, speculation, or generating income. An options contract has key components: the underlying asset, the strike price, the expiration date, and the premium. The underlying asset is what you're trading, like stocks. The strike price is the set price at which it can be bought or sold. The expiration date is when the option expires. And the premium is the price paid for the option. There are two primary types of options: call options and put options. A call option gives the buyer the right to buy the underlying asset at the strike price. Conversely, a put option gives the buyer the right to sell the underlying asset. For example, buying a call option on a stock you believe will rise in value can offer significant profits with limited risk. On the other hand, buying a put option can be a way to profit from a stock's potential decline or to hedge against downside risk in a stock you own. Exercising an option means using your right to buy or sell the underlying asset. Options are in the money if exercising them is profitable, and out of the money if it isn't. Many options traders, however, choose to trade the options themselves rather than exercising them. For instance, you might buy a call option and sell it later for a higher premium if the stock price increases, profiting without ever buying the stock itself. Options pricing is influenced by several factors. Intrinsic value is the difference between the stock price and the strike price. Time value is based on the expiration date. Volatility of the underlying asset and current interest rates also play a role in determining an options premium. For example, options on a highly volatile stock are typically more expensive due to the greater potential for profit or loss. In summary, options are a flexible but complex instrument in the financial markets. They offer various strategies for traders and investors, but require a clear understanding of their dynamics and risks. Exciting topics await in our Intermediate Trading Concepts series. Join us as we deepen your insights into the financial markets. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.